Practical accounting, the better way to learn.
Today's subject in practical accounting is cost, volume, profit, and its relationships.
The next subject is an overview of the bridge method and graph. And remember, it's all about pizzas. Now we know what our cost structure is, and we can start actually using it for forecasting and analysis. I'm excited.
You don't sound too excited to me.
This is actually my favorite little Excel sheet, and this also comes available with you. So we have the same example, 10,000 pizzas. Our total price per pizza is $10 or $100,000. Our total variable cost made up of all these things is $6 or $60,000 for the current month. Our contribution margin is $4 per pizza or $40,000. Our contribution margin ratio, which remember is contribution margin divided by the price. And this is really handy to know. This says for every dollar of sales, we have 40 cents to contribute, 0.4, 40 cents to contribute to covering our fixed costs and our profit. We also have 20,000 of fixed costs right here, made up fixed electricity, advertising, rent, and owner's salary. And we also have our first look at a break-even point. Break-even point is when you break even. You make zero profit, you sell just enough, and your variable costs change here. Now let's take a look at this graphically. This blue line goes through zero. This is our revenue line. So if we sell 0 pizzas, we have 0 revenue. If we sell 5,000 pizzas, we have 50,000 of revenue. And this line keeps going up all the way to 12,000 pizzas. We're currently at 10,000 pizzas and 100,000 of revenue in this column here. We also have this purplishly violet whatever line here. What do you think this one is? Well, this is our fixed cost line. This is our variable cost line stacked up on top. So this makes our total cost. Here's our break-even point right here, where our total costs, our total revenue have grown to the point where we cover all of our fixed costs but make no profit. As our revenues continue to grow, the difference between revenue and total cost is operating income or profit, same thing. I'm going to repeat that. Operating income is commonly known as profit in the real world. So here we're showing that we have 100,000 of revenue, 80,000 of cost, and the difference is our $20,000 of profit over here. And so that's how this graph works. Now I'm going to show you one more thing. The formulas for break-even point, number of units, percent revenue, and margin of safety and operating leverage, those formulas are still down here, but you know what? You don't need them if you follow the bridge method. I'm going to show you how to do that as we move along.
Stay on the bridge with us, Dr. Hillard and I. You still don't need the stinking formulas. How about that? See ya.
Thanks for hanging with me. This is actually the coolest subject in the whole thing. Remember when I had the graph dancing at the beginning? This is What happens if you change the variable?
This is a very powerful tool for running your business.
So we're back to our pizza shop. Remember, this is our price per pizza, our number of pizzas sold, and our variable cost and our fixed cost. These are the only 4 variables that really matter. So I'm going to ask you a question. You own this pizza shop. There are only 2 pizza shops in town. The other one just burnt down. So what are you going to do if you're now a bit of a monopoly?
Raise the price.
Well, I don't know about you, but the number one answer is we're going to change our price. We're going to raise our prices because there's less competition. So instead of selling our pizzas for $10 a pizza, we're going to sell it for $12 per pizza. So you have this file, you can play along if you want to do this. So what do you think that's going to do to our profit? Up or down? Our variable costs and our break-even point. Which line's going to change here? Well, I think the line that's going to change, you got it? I know what I think. Watch the graph. Remember, we're at 20,000. Up, and when you hit enter, did you see that? That blue line shifted up. I'm going to show you again. That was before at 10. Oink. We changed the slope of the line. We are, instead of making $4 per pizza, now we're making $6 per pizza. Our revenue is increasing at a faster rate, which leads to a lower break-even point. Break-even point before was 12 or was 5,000 pizzas. But now when we change it to $12, it goes down. We only need to sell 3,333 pizzas to break even. See, this automatically adjusts. Our contribution margin ratio was 40%, $4. It is now 50%, which is 6 divided by 12 instead of 4 divided by 10. So we're fat and happy. We're making an extra $2 per pizza. Our break-even point's down. We only need to sell 3,333 pizzas to break even. Our profitability has improved from 20,000 to 40,000, which is an extra $2 per pizza times 10,000 pizzas. Cool, huh?
You can get this Excel workbook and a whole lot more stuff at practicalaccounting.com. See you there.